Welcome or welcome back. Nike stock has been decimated in recent years, going from a peak of over $179 a share back in 2021 to falling as low as $52.28 a share back in April of 2025. But two recent purchases by Apple CEO Tim Cook and Nike CEO Elliot Hill have raised the question, is Nike now a screaming buy? In this video, I'm going to attempt to answer that question for you by doing the following things. I'll tell you, number one, why Nike stock is down so much. Two, I'll tell you the price I would be willing to pay for Nike stock with the idea of doubling my money in 5 or fewer years. Three, I'll share with you how I arrived at that conclusion so you can tell me what you think down in the comments. And four, we'll take a look at some of the technicals around the stock so we can see what the technicals in the chart are telling us. So let's start with why the stock is down so much. There's several reasons for this. This goes back several years. This is a press release from 2017 where Nike mentioned its consumer direct offense strategy as they look to shift to more direct to consumer, more of a direct to consumer model. The goal of this was to improve their margins and benefit the business overall. And initially, it looked like that was paying off. That was a move, as you could see from this article back in 2019, says Nike's consumer direct offense is paying off. And so initially, it looked like there were some positives from this move. But as time went on, it became apparent that Nike's shift to direct to consumer was not all that they were expecting it to be. This is a description of a case study product available through Harvard Business Review. And the source for this is Singapore Management University. And as this description says, said in 2024, this case examines Nike's adoption of the consumer direct offense strategy to accelerate the growth and impact of its direct to consumer model. Through CDO, the company sought to deepen its consumer connections by offering a direct and curated shopping experience, as well as increase its profitability. Nike implemented several measures, including restructuring and reorganizing of its operations, acquisition of new digital capabilities, development of an omni-channel supply chain and direct retail network, radical cut back on its long-standing wholesale distribution, and ramping up of the product innovation pipeline. Early signs of success were evident in fiscal years 2021 and 2022, with the rise in Nike's net income and gross margin primarily on account of growth in direct revenues. However, over 2022 to 2023, Nike faced an unexpected slowdown in consumer demand, resulting in significant inventory accumulation of both seasonal and off-season products. In fiscal year 2023, the company gross margins declined, while its net income fell for the first time with a 16% year-on-year drop. While Nike was not alone in this challenging time, unlike others, it did not have enough representation in third party retail to alleviate its inventory, and its absence from the multi brand retail shelves led consumers to opt for competitor brands that they could try out and compare before buying. So ultimately, the direct to consumer strategy backfired. Nike found that de emphasizing relationships with wholesalers like Foot Locker was not as beneficial as they thought and opened up shelf space for competitors. This went right along with the rise in popularity of challenger brands like On and Hoka and Adidas, particularly in regard to running shoes. At the same time, Nike was relying too much on its classic franchises, oversaturated the market with them, and failed to bring new breakthrough products to market. This, combined with less interest from consumers, led to inventory backlogs, which is almost never good for businesses like Nike. As we continue to pile on the reasons for Nike's decline, we can also look to China, where Nike has seen declining sales and has failed to compete in a market where its population has been buying more products from homegrown brands. And finally, tariff headwinds have also hit Nike, raising product costs and pressuring margins even more. Now, given all of these challenges, Nike is still a strong brand with a very strong balance sheet. So, if we assume that they'll be able to execute a turnaround strategy, what price would I be willing to pay for Nike stock today with the idea of doubling my money in 5 years or less? Since the turnaround centers on margins and revenue growth expectations, we need to figure out two key things. Number one, what could we reasonably expect Nike's net income margin to be in the future if they turn things around? And number two, what are some reasonable expectations for revenue growth out into the future when considering the total addressable market expectations for Nike's product category? Let's start with the net income margins. I went back to the 2016 fiscal year, as you can see here. And while there have been some ups and downs over the years, the 5-year and 10-year average net income margins sit between 10 and 11%, as you can see down near the bottom of the screen, with a high of almost 13% in fiscal year 2022 and a low of just over 5% in fiscal year 2018. Now, you could argue that Nike will get back to 12 or 13% or more as they benefit from automation, robotics, AI, and other innovations. But given the brand's struggles and ongoing competition for this valuation, I'm going to assume that they're going to get back to an 11% net income margin by fiscal year 2028. As you can see from this chart, I also looked at Nike's share reduction rate and their dividend history, as these are also things that will be factoring into this valuation. The second thing I said we need to figure out was a reasonable revenue growth rate for Nike in the future, given the expected growth of the total addressable market. I looked at some different sources, and it seems the TAM for Nike's product categories is expected to grow between 6 and 9% between now and the early to mid 2030s. Given the competition Nike is facing, and also considering that they already have significant market share, for this valuation, I'm going to assume 7% revenue growth is the maximum revenue growth rate that they'll be able to achieve between now and fiscal year 2032. So I looked at valuing Nike a couple different ways, and here's the first one. So I'm assuming revenue growth of 0.82% in fiscal year 2026, 4.29% in fiscal year 2027, and then 7% in fiscal years 2028, 2029, and 2030. I'm also assuming net income margins of just under 5% in fiscal year 2026, just over 7% in fiscal year 2027, and then I assume we'll get back to that 11% net income margin that I mentioned earlier in the video. I'm also assuming that they're going to reduce their share count by about 2% each year, and that they'll grow the dividend out to fiscal year 2030, that the dividend will grow, and you can see the dividend growth rate here in this spreadsheet that I have factored in. I think this is more sustainable. It is lower than their dividend growth rates in the past, but I believe that when you factor in the challenges that the company is facing, I don't believe that they'll be able to grow the dividend at the same rate that they have in the past. So you can see with these assumptions, this brings us to an earnings per share of $4.91 by the end of fiscal year 2030. And so here we can look at the different PE ratios on a trailing basis after fiscal year 2030 at $4.91 earnings per share, what the stock would trade at. You also see the total dividends that you would be paid between fiscal year 2026 and fiscal year 2030. And then also I've taken out, that's why this is in red, I subtracted out the dividends that are already committed for fiscal year 2026. And so by the end of fiscal year 2030, the idea would be at these different PE ratios, this would be your total return. I will note that this would be a total return with no cost basis. So you have to subtract your cost basis out to actually see what you would make if all of these assumptions hold true. Also, for part of the fiscal year, the dividend was 40 cents, not 41 cents. We might be off by a penny or two here, but we're just pinching pennies here. So the question then becomes, what multiple do I think the stock is going to trade at out beyond fiscal year 2030? So I have some thoughts here. They do have a strong balance sheet, and their brands warrant an above average multiple. The single digit growth projections and erratic historical margins do not. So when we look back at these margins, the net income margins for the years I factored in here or looked at in this spreadsheet, it's been a little bit up and down over the years. It hasn't been consistent. So that is a factor, that it's not always a consistent net income margin. Competition and apparel risks do exist. We're already seeing companies like On and Hoka challenge Nike. You have other companies that are also going to challenge Nike in apparel. And fashion risk is always a thing with companies like this. Nike's one of the strongest brands that there is, one of the most durable apparel brands, but you're always going to have fashion risk with companies like Nike. I'm skeptical that they can achieve a 7% revenue growth rate out in those future years that I factored into this. Do I think that they can? Sure. Do I think they can exceed that? I also think they could, but I'm skeptical that they even achieve 7%, to be honest. So that's another factor. Might just need a little more margin of safety if I'm not as sure about that future revenue growth being there. The historic market multiple is about 15 times earnings. With the way the market is right now, you have to remember that. We're seeing right now a market that's trading much higher There's different reasons for that. That's for another video, but it's something we want to keep in mind. We have to consider that Nike's already in quarter three of fiscal year 2026. So if we're looking to double our money by the end of fiscal year 2030, that is actually less than 5 years. So that already provides some margin of safety just on a time basis. So given Nike's risks, struggles, slowing growth, and already saturated market position, combined with the valuation of the overall market, I would buy Nike stock. And don't go away after this because I have another valuation model I want to show you too that I think was also is worth looking at. But I would buy Nike stock at a price of $41 per share. And you might be saying that is significantly lower from where it is now. I know it is, but look, just because a company has traded at a certain multiple in the past or even does now doesn't mean that it deserves to always trade at that multiple. And if they're going to grow revenue at a slower rate, if they're only going to have single digit revenue growth, yeah, the balance sheet is good. They don't have a ton of debt or anything like that. But even with improving margins, if they don't have the growth to justify a higher multiple, over time, that's going to eat away at your returns. So you have to think about that when you're thinking about what you'd be willing to pay for a company. The way I look at it is I don't need to buy it. It needs to be an opportunity for me. And to be honest, if I look at these PE ratios here after fiscal year 2030, and if my assumptions come true, what it would trade at, I think that an apparel company like Nike with fashion risk and all these other things built into it, if they don't improve the margins as much as I've mentioned here, if they don't grow revenue as much as I've mentioned here, you could even see a lower multiple than 15. Now, to be honest, in normal healthy market conditions and normal healthy conditions for Nike as a company, yeah, I could see people paying 17 and a half, 25 times earnings, maybe even 30 times earnings for a Nike. But that doesn't necessarily mean that it's actually worth that when you consider the growth and some of the other things that I've pointed out in this valuation in this video. So let's look at this another way. So let's look at the other valuation model that I mentioned. This is looking at it more of as like a DCF. And I looked at using a weighted average cost of capital. I decided going with a market return um, was a pretty good way to look at it this way. If you look at I went out 10 years on this one, and you can see the revenue growth. I went with 7%, 7%, 7% in those fiscal years 28 to 30, like I did in the other model. And then I said they'll continue to grow at 7% for a couple more years after that. And then I tapered it down to 6%, 5%, 4%, and did a perpetual growth rate of 2.5%. You can also see the net income margins I went with and the stock-based comp, free cash flow to net income percentages there, margins there that I went with. I'll scroll over here in case you want to look at any of the other numbers on this. If you have questions about any of it, feel free to ask in the comments. But ultimately, I got a fair value of equity this way of $47.01. And then if you look at having a 10 to 20% margin of safety, it falls right into that $41 per share range. So ultimately, I believe $41 is the price that I would have to pay to get the kind of return I want with a stock like Nike. Let's take a look at the technicals for a minute. So if we look at this chart, if we draw Fibonacci retrace from the lows way back out, decades ago, and we draw draw this as a consistent uptrend on this fib retrace up to the high from back in 2021, you can see that you've got a 786 retracement at $38.41 per share. So maybe, it goes a little lower than the $41, and that's where it finds significant support. There are some other supports built in here, as you can see with the white lines I've drawn. You can also see that it appears to be rejecting off of the 200-month moving average here. It rejected off it in November, and it's struggling again in December, or it has struggled again with December. It's the last day of the month. If we look at the daily, we can see it's still below the 50-day and the 200-day moving average. Looking at this, I wouldn't be surprised if it fills the gap here up from the gap that was created between December 18th and 19th. If it fills that gap and then rolls over to the downside and looks for some more support lower, I could definitely see that happening, especially depending on what happens with overall market conditions. Another factor is what's going to happen with the hype around the stock after that CEO buy and Tim Cook's buy, and that kind of fades off. The sentiment around that sort of fades off. Yeah, it was up over 4% today on the news that the CEO had purchased shares. But that doesn't mean that's going to cause a durable move to the upside. So we'll see what happens with it. I wouldn't be surprised if it goes lower. I won't be interested in buying Nike unless it goes lower. But if you disagree with me, let me know in the comments, and be happy to talk to you about it. If you're willing to pay more than $41, like I said, for this company, tell me your reasons. You think that they're going to have better margins? You think they're going to grow revenue more than this? You think there's other things that are going to help the business, AI, automation, whatever it may be? Let me know what you think about Nike and what you'd be willing to pay for it. I hope you found this video helpful or informative. If you did, subscribe so you can see if I ever do buy Nike stock, and you can follow me along with the investing moves that I am making out into 2026 and beyond. Don't forget to like the video, click the bell to get notifications, follow me on X at Stock Sale Flyer, leave a comment below. Tell me what you think about Nike and what your opinion is. And as always, the information in this video is time sensitive and it's not financial advice. Thank you guys so much. We'll see you in the next one. Bye.